You are listening to KeyStone's Stock Talk Show, episode 316. It's great to chat with you again. This week, I kick off the show with a star update on a stock that is no stranger to clients. Boyd Group Services Inc., symbol BYD on the TSX, was jumped around $20 last week after a significant acquisition announcement. Growth appears to be reigniting for the company. In our Your Stock Our Take segment, Brennan answers a viewer question on Toromont Industries Ltd, TIH, on the TSX, which provides specialized capital equipment in Canada, the United States, and internationally. Brennan also takes a look at a recent article he penned entitled "The Mining Money Trail, Junior Mining Financing Heats Up in 2025. Last but not least, Brett will tease an upcoming special report he is set to release for our Canadian income and VIP clients focused on banks and non-bank lenders in Canada. All right, let's get to the show. I welcome my co-host, the Killer Bees, Brett and Brennan. How you guys doing?
Well, not that great. The weekend could have been much better if the Jays,
Yes.
if they
It was
closed
so
it.
close. I think you couldn't get closer to winning a World Series without winning a World Series, going to extra innings in that game and having the bases loaded at one point and not being able to bring anyone across the plate. It was gut-wrenching. The team was very likable. And honestly, if you went through the series, I don't think you would have thought this going in, but I think the Blue Jays outplayed the Dodgers, who were favored going in. And somehow, in kind of gut-wrenching fashion, the Dodgers hit a couple home runs, hit a home run in extra innings and won the game. And it was... I think that it was great for the country. You have one baseball team in the country, so most were supporting the Blue Jays. You saw a lot of people come together. I know in my house, like we had my mom is screaming in the background, who's grandma in the house, right? And it really isn't watching it all year long. Myself and my dad would be watching it, like game 62 on a Wednesday, or you watch the Blue Jays in 30. But like people who were not watching it came together and were watching the series and got so into it and got so into the team who, it's a bunch of guys like Ernie Clement, led. He had the highest number of hits in baseball playoff history in this run. And this is a guy who was released by a team a couple of years ago and just signed on because the Blue Jays would maybe give him a chance to play. And he ends up having the most hits in an entire play. You're going back hundreds of years, not hundreds, 100+ years in baseball history. And he ends up with the most hits. I mean, I know the playoffs are expanded a little more now, so there's more of a chance, but tremendous stories on the team. Vladdy was unbelievable. Trey Savage, hopefully he's the ace that they need. And that's enough Blue Jays talk probably. But anyways, it was depressing to see that.
I mean, even for myself, I've been a Blue Jays fan for about 30 days and it was quite depressing for myself. No, I
go back to Joe Carter, 92, 93, 94, those great teams there where the last time they made it and they won consecutive championships. And this appeared like they were going to do it again 27 years later, but it's Brennan's fault because he's a bandwagon fan and he bandwagoned the Oilers and they lose. Well, I thank him for that, but yeah, we'll blame you.
And it was Halloween this last week.
And that was cool. Trick-or-treating it was on a Friday, which is always cool because you get to really kids get to go out and really get way too much candy basically. And it was fun. I dress up and scared the crap out of my daughter and her friend, which is always fun. But they're like, I thought, well, maybe I won't do it. And they're like, oh, do you think we're going to get scared this year? Or do you think you're going to? Oh, okay, well, we'll do that. Anyways, nice. It's good. That's cool. Funny. Brennan, did you dress up?
I did not dress up, but I helped hand out candy.
I ate my candy.
I also ate
nice.
some candy.
Brennan dressed up as a regular human being, which he does on a daily basis, right?
Exactly.
You're faking it. That's good.
Yeah, I dressed up as a Blue Jays fan.
That's true. Yeah. Anyways, well, now we get back to cheering against everything that comes out of Toronto. So that's cool. Or just booing everything. So, well, it's the only thing that comes up. Like you could not, out west and most of the country, you can never cheer for the Leafs, right? Like, or I guess the Raptors. I guess we did have the Grizzlies out west for a while, and then they moved a team.
It's unfortunate.
Sporting teams, bloody.
But yeah, should we get to the poll?
Yep, let's do that. This is a stock talk show.
So. We'll see about that at this rate.
Yeah. All right, let's get to it. Brett's got the poll.
Nice and quick poll. Do you hold any shares in the big six Canadian banks, RBC, TD, BMO, CIBC, Scotia, and as well National, the smallest of the six? For our viewers, 37% said yes, they own shares in one of the banks, and 63% said no. I actually thought it would be higher. I thought
I'm
it was
absolutely shocked.
Slightly
and I don't know are people not factoring in indirectly, or I guess through
probably
any
not
ETF, or I mean, we see portfolios all the time, and it's almost 100%, to be honest, have some bank exposure, mostly direct. So I was shocked to see that. I mean, I voted yes. There is some exposure.
Yeah, I'd say as well. I would assume that our YouTube audience probably again skews maybe a little bit more to the small cap audience or small cap side of things. I was still, I agree. I was surprised as well. I was thinking that it was going to be, more. And like Ryan said, there's probably a lot of people that don't understand that, they own, it through an ETF or whatnot. It surprised me. This is a bit of a tangent, but just the amount of people who, put money into an RRSP and don't understand what they're actually buying. And when I have conversations with just friends, and it's oh yeah, I've been buying RRSPs. They tell me, and
the whole buying RRSPs. You have one RRSP, and you buy things under it. But anyways, I know we should. It's people don't know.
No, exactly. It's just
how the structure.
But
what's in those RRSPs, you say, and they don't even know. There.
Well, exactly.
Yeah, it is. Honestly, we have done some webinars in the past where the basics of tax sheltered accounts, RSPs, TFSAs, and maybe we cook one of those up for the new year again, because it just you think everybody knows, but a significant percentage of the population doesn't even understand the basics of it. So it's good to get that out there once every several years. So maybe we'll have one of those segments where we just talk about the basics behind that and how to set them up.
Yeah. And I'm looking forward for Brett releasing, this financials report. It will be good for clients. And, there was just some of the research that he was doing, just even surprised myself, looking at the performance of some of the banks and, comparing them to the overall market.
Yeah. And we'll get into that today for sure. Yep. Okay. Well, let us get into the show. I am going to share my screen. Okay, again, I'm going to talk about the Boyd Group Services, Inc., a company that is no stranger. We go back to 2008 when this company traded at $2.30, paid a ton of dividends since then, is up around 10,000%. Trades today at $225, $4.8 billion market cap, 0.27% dividend. What does Boyd do? They're one of North America's largest operators of non-franchised collision repair centers. Business model is focused on auto-related services, primarily collision and auto glass repair. The collision repair is core to the business. They operate full-service auto body shops that perform repairs ranging from minor cosmetic damage to major collision damage. Auto glass is big for them too. They are a major retail auto glass operator providing repairs and replacement services for windshields primarily. Ancillary services they provide include specialized services like advanced vehicle scanning, calibration necessary for modern vehicle systems like ADAS after a collision, and emergency roadside services. They operate 130 locations in Canada, approximately under the trade names Boyd Auto Body and Glass and Assure Automotive. as well as 800 plus sites in the US under the Gerber Collision and Glass brand, for a total of around 930 centers. That will change after the upcoming acquisition. We'll talk about that in a second. In the US, their brand is Gerber Collision and Glass Repair. And others they have in the US as they've made acquisitions. Another name is Glass America they operate. Now, their business model the business thrives on deep relationships with major auto insurance companies like direct repair programs or DRPs. Insurance prefers working with large, reliable multi-shop operators like Boyd because they can offer consistent quality, standardized process, and lower administration services. Let's look at that all-time chart. There's a return there. You add the dividend, and it's around 10,000% return. But why did the stock spike just last week? Well, they announced a significant acquisition for the business. They acquired Joe Hudson's Collision Center. The company's a leading player in the U.S. Southeastern collision repair market. They also concurrently announced preliminary Q3 2025 results, including positive same-store sales growth. That is the first time in around 6 quarters that they have done that. So that was relatively significant. Let's look at some of the details on the Joe Hudson purchase. This is the first significant purchase they've made in a number of years following COVID, where the business was derailed a bit during that period. Boyd indicated the purchase price equals to an adjusted EBITDA multiple about 13.3, which could fall to 9.3 times post synergies. Concurrent with the deal, Boyd launched a $780 million equity offering, effectively structured as a U.S. IPO, which will see Boyd list on the New York Stock Exchange under the symbol BGSI. On October 30th, about a day after this announcement, they announced they had priced a private placement offering of around $525 million. That would be Canadian principal amounts, senior unsecured notes. Now, the deal in terms of this deal was priced, the offering that was above here was priced at $141 per share, US 196 Canadian, adding more than 25% of the shares outstanding. The remaining purchase price will be funded via US high yield debenture offering that was above and a draw on the corporate revolver. Debt to EBITDA after leases will climb from 2.7 to 3.4 upon close. Management stated that sufficient financial capacity will remain for Boyd to continue to pursue its stated growth target of 80 to 100 additional locations per year. This acquisition has basically checked off all of that that is needed for this year. Q2 fiscal year 2025 highlights. These were released a couple months ago. Sales increased by, they were basically flat to $780 million from $779 million in the same period of 2024. Same store sales declined by 2.1%, offset by $21 million in revenue from new location growth. Second quarter of 2025 recognized the same number of selling and production days when compared to the same period last year. So it was like to like. Gross profit increased by 2.8%. $365 million or 46.8% of sales, up from 45.6% in the same period. Adjusted EBITDA increased 4.7% to $93.8 million, while adjusted EBITDA margin increased about to 12% from about 11.5% of sales in the same period last year. Adjusted net income or net earnings decreased to $10.8 million from $11.9 million in the same period of 2024. On a per share basis, decreased to 50 cents from 56 in the same period of 2024. Prior to the adjustments for acquisition, transformational cost initiatives, Boyd posted net earnings of $5.4 million, down from $10.8 million. So let's look at the valuations. On a PE basis, it looks expensive. On an enterprise value to EBITDA basis, trades at based on 2025 estimate of 11.5. PE drops significantly. Earnings are expected to spike in fiscal year 2026 and it's about 36.2 times. EV to EBITDA would go to about 10 times 2026 expected numbers. So quick conclusion here. Again, since our recommendation, Boyd has gained approximately 10,000%. The preliminary Q3 results suggest continued improvement. Management expects revenue of 787 to 792 million, with same-store sales growth actually flipping to positive to the 2 to 2.5% range, the first positive same-store sales growth in 6 quarters, with EBITDA margins recovering to an estimated 12.3 to 12.7%, supporting EBITDA of 97 to 99 million ahead of the acquisition. The company had already added 17 acquired locations and 7 greenfield stores in the quarter. Clients will be updated on the stock shortly, and there are our disclosures. Any comments, gentlemen?
I mean, just good to see that switch in same-store sales growth for sure.
Yeah, you want organic growth and you want acquisitions. There wasn't a ton of organic growth. They're flipping to what it looks back to some organic growth, and the acquisition environment has become far more positive. And this acquisition was a certainly a significant one for the company. So they had kind of tracked down to lower multiples. There is a thought that they once again get re-rated to higher multiple levels. So we shall see if that happens over the course of the next year. But I did see a number of analysts had just revised their targets higher on the company. So that's a positive.
You've seen over the past 5 years, the share prices really stayed in the same area.
Yeah.
Versus prior, if you look, there's a big shift with that COVID, which the fundamentals did shift at that point in time. The market's never really readjusted since that, where you saw that actual, I think, 15% decline in sales in 2020, something in that ballpark. And it just past that, even though they had same store sales in 21, 22, 23, and then a decline again last year, you just never had it actually appear in the share price.
Very significant headwinds that the company faced. Obviously, people stopped driving in that period, and then they fought through that a period that you just wouldn't be able to forecast happening. Then they had cost inflation, so wage inflation, and they had wage inflation. And then it was just very difficult to get technicians. It is flipping for them now, and you're seeing the improvement in the numbers. And they weren't making a ton of acquisitions. They were playing defense at that time. This is a very significant acquisition. They added 258 collision repair shops, to a total, there was now around 900 when you look Canada, North America. So Canada and the US. So that is a significant add for them. It is a company too. This company was very acquisitive. Joe Hudson's was over time. So kind of a mini Boyd, and that they believe the cultures will, they will meld well. We'll see. That is something that is only proven over time typically. They also geographically, this is in regions where Boyd was not exposed, so it is a good fit from that perspective as well. And they can plug into Boyd's buying power, and they think there'll be some synergies that'll be taken on. We have heard, not from Boyd, but from other businesses in the past, here are some synergies that are going to come in, and then it never comes to fruition. So we'll see if Boyd can do that. But I mean, Boyd has done this on a smaller scale for years, and been able to bring in a great ERP system across the system, use their buying power, use their marketing power, and create cost savings from the acquisition. So you buy at a certain multiple, that multiple goes lower because you're able to plug them into your kind of program, which hums along the engine of the Boyd is, and has the better buying power, and they get cost synergies that actually do come to fruition, and they grow over time, and they're well on their way to hitting their targets for 2029 to 2030, and then they'll do another 5-year plan. And so this is certainly a positive for Boyd, and I'm not surprised to see the share price jump up. All right, well, we can move on to our next segment. Brennan is going to, do you want to talk about your article first leading into Toromont, or do you just want to talk about Toromont?
I just kind of get right into it. I'll show you. So yeah, I guess essentially I wrote an article on our website titled "The Mining Money Trail: Junior Mining Financing Heats Up in 2025." And I covered specific service companies which could benefit and used some real world examples, such as, drilling companies. We do have two other drilling companies that we like within our coverage, but I did cover, major drilling in this article, as well as, I covered it on the podcast last week. There's also, engineering firms, such as like Eagle Plains Resources, for example, which I've covered on the podcast in the past. Now, it's not a pure play engineering firm, but it does own Terralogic Exploration, which essentially is generating 100% of the company's revenue. It isn't, a company which screens very high for us, as it's not profitable, but, it could benefit from, an uptick in financing for juniors. And of course, last but not least here, equipment and logistics providers such as Toromont, which is an equipment provider. So I thought that I would do a review on the business today, since the last time I covered it on the pod was about a year ago. So Toromont Industries Ltd, TIH on the TSX, currently trading at a price of about $165 per share, $12.8 billion market cap, and a dividend yield of about 1.3%. So they provide specialized capital equipment in Canada, the US, and internationally, and they operate in two segments. It's Equipment Group and CIMCO. The Equipment Group segment engages in the sale, rental, and service of mobile equipment for Caterpillar and other manufacturers. And the CIMCO segment is involved in the design, engineering, fabrication, installation, and after-sale support of refrigeration systems in industrial and recreational markets. And at the last quarter, over 88% of revenue came from the Equipment Group segment. So that is primarily most of the business. Now, as I noted, the last time I covered the stock was about a year ago, when it traded in the $125 range. At that time, I said that, I wouldn't bet against Toromont long term. They've grown the dividend very well, great long-term growth, and the stock has performed quite well since then, driven by strong financial results, with the stock up 47% year to date. And again, impressively, the company is really a dividend aristocrat, having grown its dividend consistently for the past 35 years. And that payout ratio remains healthy, which I'll go over in the conclusion at the end. Now, let's look at the financial results, which have been driving that share price higher, as well as those dividend increases. So looking very long term, we can see revenue has had a positive trajectory since 2015 and has grown over the last 9 years with a compound annual growth rate of about 12%. They do make acquisitions, so keep that in mind. But most impressively, net income has grown with a compound annual growth rate of 15% over that same period. Now, looking more granularly at the most recent quarter for Q3 of 2025, ended September 30th, 2025, revenue was actually down 2% to $1.31 billion and was driven by lower revenue in the Equipment Group, partially offset by strength in CIMCO. And net income was $141 million approximately, or $1.73 per share, which is up 8% from a gain of $131 million or $1.60 per share in Q3 of 2024. Now, I also wanted to highlight that there is seasonality in the business, with the equipment segment posting its weakest quarter in Q1 due to winter shutdowns, while Q4 tends to be the strongest quarter as it coincides with the timing of customer capital investment decisions. Looking at the balance sheet, it's always had a quite a nice balance sheet, which is why I've liked the business. Net cash position of about $217 million. And the business has been buying back shares slowly and steadily. Looking at the backlog, it is up 15% year over year to $923 million from $803 million, while bookings were up in Q3 by 49% compared to Q3 of 2024 year over year. So bookings and backlog certainly remain robust at this time. Looking at the trailing valuation, the stock trades at about 28 times trailing earnings. The last time that I covered the stock, it was at about 20 times earnings. And if we look at its primary comparable, Finning International, Finning is currently trading at about 20 times earnings or 20 times trailing earnings. So, comparatively, Toromont is more expensive, but I will note that Finning has posted weaker long-term growth and has a significantly worse balance sheet. It's still sustainable, but I just love the cash-rich balance sheet that Toromont has. And looking long-term here at the bottom of the screen, the median trailing price to earnings ratio for Toromont is 20 times over the past decade. So right now, the business is trading at a premium, looking a little bit pricey in relation to its historical multiple. So to conclude, Toromont is a solid dividend aristocrat, having grown its dividend for 35 years consecutively and only pays a payout ratio of about 33%, so it can continue to support dividend increases. The company has a solid cash-rich balance sheet and robust backlog. Bookings are also strong right now as well. Compared to peers like Finning International, investors must pay up essentially at 28 times earnings for Toromont. But seeing the better balance sheet and history of growth, I certainly see why the business trades at a premium. But I will say Toromont is currently trading above its 10-year median price to earnings multiple of 20 times. So right now, I believe that the business is maybe a bit more on the pricier side. Now, if someone was looking to hold Toromont in their portfolio long term, I think that it's a solid business. They might potentially benefit from more activity in the junior financing space, but right now, I would be a bit cautious paying the elevated valuation for the business. Now, another thing that I didn't go over, but I'll just quickly mention at the end here. On January 31st, 2025, the company did acquire 60% of the shares of AVL Manufacturing Inc., which is a leader in the design and fabrication of power generation and storage enclosures, for consideration of about $67.5 million cash, plus the issuance of about 110,000 Toromont shares. Now, the company has committed to purchase the remaining 40% at various dates through to 2031. So they will be acquiring the rest. But at the time of the acquisition, AVL had operations in Hamilton, Ontario, which has now subsequently expanded to the US. They acquired a facility in North Carolina for approximately $60 million to expand capacity to serve the Eastern US market, with the first phase of production during the Q3 expected during Q3 of 2025. So, right now, I like the business long term. I just think that, near term, I'd be a little bit cautious paying the elevated valuation multiple compared to its historical multiple.
Yeah, I think it's a good assessment. I mean, I think it's a quality business. I think the dividend growth has been strong, and I think you're right. It trades at the premium end of its multiples. If it was a pullback, this is the type of company that we'd be looking at to add.
Yeah, certainly.
All things being equal.
Mm-hmm.
Yeah, I mean, if
all of a sudden,
6
the
months from now,
backlog,
like clients always ask, what would you add at what price?
Yeah.
Well, we can't say a price because there might be a reason they fall 30% and then they're not a buy at that price. And it could go up 20% and be a buy too. So, because something could change, they could double earnings and only go up 30% and then they're a buy, right? So, clients are always like, oh, what's the entry price? Well,
Yeah.
we will see what the valuation is if it drops or if it stays in the current range. It could stay in the current range and become a buy in a year if they grew earnings. So it's not just price you look at when you look at, and that's why, when we get, what is the price? What should we buy at? If today we can tell you, but by the time it gets to that price, it may be a different financial picture that we're looking at. Let's move on to Brett's segment. He's going to tease his significant special report that is upcoming on Canadian banks and other financials in the Canadian market. Correct?
Exactly. But yeah, like Ryan said, we're doing a upcoming special report focused on banks and non-bank lenders, so the non-prime or subprime lenders in Canada. And what I have up here is really just to highlight really the amount of exposure most people do actually have to banks, even though they don't really realize they do if you do hold ETFs. So I have XIU up, which is just an ETF tracking the TSX 60. And you can see here the big banks, they have a large share of market weighted indexes like the TSX 60, but also the composite. And then you also have financial ETFs, which people will commonly ask us about, which are just even more so dominated by the banks. So the big six banks, RBC, TD, BMO, Scotiabank, CIBC, and National Bank, come in at a cumulative weight of 27% of the TSX 60. So over a quarter of the index between the six banks, even though 1/10. So well outsized on a per stock basis. With all of them, besides National, which is significantly smaller than the others, being in the top 10 holdings for a TSX 60 passive ETF. So broad market passive index investors in Canadian markets will likely have significant exposure to the big banks regardless. So when you are looking at a portfolio comprised of single stock like we do, you do want to actually look at the big banks. You don't want to be a closeted index investor by any means. I'm not pushing towards that, but you do want to actually look at what is making up these indexes and why. And we can just see why in the historic returns right here, why. It shows the massive outperformance compared to XIU, the ETF that tracks the TSX 60 over the past 26 years, was just how long TradingView had data for it, just to show this nice and simply. So you can visually see how correlated the banks are with one another as well in this. You can see during 2008, right here, with it all declined together. Same with the broad index. You can see in 2020, the same thing, as well as periods of rising like right now. They're all very, very correlated. But over time, you do see this dispersion with National tripling Scotiabank's return over this period. You can see over 4,700% return, and this is dividend adjusted. So in reality, you'd likely get slightly less if it's in a taxable basis. But if it was in, which didn't exist at the time of TFSA, you would actually see these returns if you were continuously reinvesting. But the point is, you do see this dispersion. You have National followed by Royal really outperforming the other banks where they're much more closer tied together on a return basis, with CIBC being the third, which is a bit more of an outlier, but still more clumped together. But they all well outperform the TSX 60. So just looking at the performance with dividends not included, so just the price performance, the banks still actually do outperform the broad index over the same period, just less so since a higher proportion of returns are from dividends. But even if you are just saying, I don't care about the dividends, which some people do, you should care about it. You should be looking at total return. Even on just a price basis, you can actually see some outperformance historically over the long term. There is a bit of a caveat there that because of just the time period, this is back to 1999, there was the dot-com bubble, and you can see that with XIU, there was a peak, and then it really underperformed for quite a while. But if we look at, similarly, the S&P 500, dividends adjusted here, so dividends included, reinvested, it does actually outperform the S&P 500 as well. Just to about the same degree when dividends included over this period. That's merely coincidence with XIU and SIP or SPY performing similarly, but the point is very strong performance of the bank over the long term. But there are periods of underperformance. You can see here 3 years with dividends included even. SPY has outperformed all the banks except for National. So people will always say, why are you investing in banks? They're low risk, they're low return. But this isn't a massive difference here. And over the longer term, we can see outperformance, even when it is classically lower risk asset being a bank compared to the tech-heavy S&P. So far this year, there has been overperformance led by TD, and this is more so due to prior underperformance given the U.S. anti-money laundering fallout, which capped the U.S.-based assets of $434 billion, which it has subsequently restructured a significant degree of its U.S. balance sheet, as it was near the limit at the time the cap was imposed, as well as the bank notably divested its stake in Schwab for $14 billion early this year. So there has been a significant shift, probably more so than the other banks in the last couple of years. So it was underperforming, but year to date, it has done phenomenally with a 51% total return. So amazing. Or sorry, that is actually the capital returns with no dividends. But if we take a step back and focus on the broad valuation shift, the years on a price to book basis, we can see a notable uptick in valuation, shifting from an average of 1.6 times at the start of the year to 1.87 times. So that's still increasing its forward expectations quite a bit, even though the results, and of course it is a bank, your book value per share every quarter should be expected to tick up barring any significant downturns. The market is valuing banks at a higher premium than what it was. And this is even after the April crash due to tariffs, resulting in Q2 earnings across the banks really being dampened by high performing loan provisions for credit costs due to high uncertainty. So effectively, those are loans which, on an idiosyncratic or individual basis, that they're performing fine, but because macroeconomic uncertainty is so much higher, the bank takes a performing credit provision. But they can, lots of times, they will release those credit provisions if nothing comes to case. So if tariffs, the whole issue falls apart, tariffs are no longer an issue, they will release those provisions, which will actually cause a big jump in earning during those quarters. They would release those. But in Q3, uncertainty appears to no longer be at least accelerating. It plateaued. Peak uncertainty was a comment which many of the banks were making, something along those lines, with performing credit provisions falling significantly sequentially. So the Q2 or the Q3 earnings, you can see just on the graphs there, strong performance across the board, with the exception of National, which did fall from the quarterly results, but very strong performance for the Q3 results across the board, really coming down to the commentary around just the outlook is better. It's as simple as that. The macroeconomic outlook is better. And that is something which you really need to be conscious about when you are investing in financial assets, especially large financial assets. It is bound by macroeconomic conditions, good or bad. So looking forward into 2026, the big question will be Kuzma renegotiations, which are set to begin in July, which who knows with the American administration at this time, are they going to just completely throw a wrench in it? As at this time, Kuzma really has safeguarded Canada for much of the tariffs. Most companies and people who were importing and exporting weren't really even actually applying to be exempt under Kuzma before, but now we have about 80%, depending on the metric you use, of the Canadian exports to the US being covered by Kuzma. So if that agreement breaks down, shifts substantially, you could have significant shifts in the Canadian economy as well, the banks, of course. But our Canadian dividend clients, as well as VIP clients, can look forward to reading our full special report in the very near future, which will go further in depth into all the banks, as well as the subprime lenders, which are quite interesting at this time. But yeah, I don't know if you guys had any comments there.
Yeah, we definitely have some updates on some companies that are already in coverage there, and some recommendations there of, essentially what you should buy. Maybe not completely inside of the big five, 6 banks there, but there's certainly going to be some recommendations for clients within that report as well. And we look forward to that. I happen to have a preview of it, and it's a great report. It's well done, well put together, and we're really happy to be sharing that over the next week to clients. Anything further, Brennan, or you're
No,
still?
I think that's
Brennan's
good.
in pain right now.
Yeah,
And it's not just from the Blue Jays, right?
Correct.
But I do like your shirt.
Yeah, or my sweater. Yeah,
the sweater.
It's great. I was
Good
lazy.
shirt.
I didn't iron a shirt today, so.
Awesome. All right. Well, that should end our show this week. We will have coming up announcements on our final webinars of the year. Excited for that. But right now, I just like to say, if you're looking at us right now, if you're watching us on YouTube, smash that subscribe button. If you are listening to this wherever you consume your podcast, rate and review us. As always, keep your questions coming into our Your Stock, Our Take segments, and we'll endeavor to answer those on a weekly basis. As always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.